All right, so we're gonna start with Berkshire Hathaway. The big move that immediately jumps off the page is Google, Alphabet. They didn't just nibble into Google; they massively increased the position. Berkshire increased its total Alphabet stake by 80%, and their total exposure right now with this public portfolio, not the entire Berkshire Hathaway, their stock portfolio is like at like 13% Google, which is a large position. So, but there's an interesting detail here. Warren Buffett is the one who initiated the Google purchase, not Greg Abel, and probably the most of the cleanup that we've seen in first quarter is done by Greg Abel. And some of these exits that we see here reduced Bank of America, Capital One, Ally Financial. This is just a continuation of that. He's exiting the financial part of the portfolio, leaving American Express in there. So yeah, Buffett, he personally said he confirmed that he personally initiated the Alphabet investment. So I don't think it's good anyway. At this point, it's not a good entry, in my opinion, with this AI mania. It's pumped up. Google was very undervalued last year. I bought it at like 150. I sold out of it since then, since it went parabolic. After something goes parabolic, especially some mega cap, large cap, there's no reason to keep it. I mean, it's just not going to continue to bump up and pump trillions of dollars into the market cap continuously. I mean, it's just not going to happen. But yes, when something goes up a lot, I tend to stay away. So I don't know, Warren Buffett, he used to be the guy who just bought undervalued stuff that was at a discount, price going down in the stock. Seeing him buying more, and he's like 91 years old. I mean, or 95, and just yeah, I don't agree with buying Google right now, especially since we have this crazy AI bubble, and Google capex is very exposed to that. So yeah, they're putting serious money behind Alphabet, and this company is spending aggressively to defend and expand its position in AI. And Berkshire wasn't just buying; they continue reducing the other positions they had, and the portfolio now looks completely different. It's like very tech heavy: Apple, Google, and other very high margin stocks. Just because Warren Buffett, guys, just because Warren Buffett bought Google, that doesn't mean you automatically have to also buy Google just because it's Warren Buffett. Charlie Munger bought Alibaba at like 240. It went down to like 55. Dude. I know some people that even were making YouTube videos at the time. They were saying, "Oh my god, I just made the biggest purchase of my life." Alibaba is at like 220. If Charlie Munger got it at 240, I'm getting a steal buying it at like 220. And it kept dropping and dropping and dropping. And then at like 150, Charlie Munger came out and said, the biggest mistake of my life. Do not copy other super investors just because they are famous. I mean, some of these people are very, very old. Also, some of these people can get very, very stupid, as we're going to see next with Bill Ackman, okay? I'm not saying buying Google is a stupid investment. I'm just saying it's just not the right timing. And even Warren Buffett can make mistakes, guys. Just because he's the greatest investor. I love Warren Buffett. I learned a lot about it. In the videos that I will keep making, you will keep hearing me talk about Warren Buffett and his philosophy. A lot of his investment philosophy I incorporated into my own investment strategy. So, but just because he makes a purchase, that doesn't mean it's automatically good. Okay, first of all, Berkshire Hathaway is massive. They don't have a lot of options. If they want to deploy 10% and put some meaningful capital into something, they have to look at the big caps. There's no other way. Apple, Google, Amazon, Microsoft, these are the only ones. So yeah, let's move on. Next we have Bill Ackman, the snake. He's back to Netflix, guys. This quarter, Ackman was busy. They started the new positions. Pershing Square started new positions in Visa, MasterCard, S&P Global, and Netflix. S&P Global is right now at a very attractive price. It's on a almost 30% dip when I bought it anyway, last week or 2 weeks ago, around $400. So 30% dip. Visa and MasterCard, all-time highs. You're just not going to make money. You're not going to outperform the index with these buys. I mean, Netflix is how much down? Almost 50% or so. But yeah, each roughly has like 5% position. So it's not like buying Visa and MasterCard for 5% each and then putting also 5% into Netflix, which is down a lot. It makes no sense. But anyway, let's just make a little fun of this guy. He's not a stupid person, okay? Bill Ackman seems like an intelligent person, okay? He seems like, I don't want to give verdicts here. He just seems intelligent to me, okay? But let's just go through what happened back in 2022. And Warren Buffett always says, you don't make a lot of money in this game with intelligence. Sure, it's helpful to be smart and intelligent. Actually, it's much more helpful to be smarter than intelligent. Something like David Tepper. So Bill Ackman bought Netflix after the stock price went down like 60% or more. And then after 3 months, a quarter, he completely sold out. He bought like 11% of his entire portfolio. He put in Netflix. He lost immediately like 500 million, like $500 million out of like 10, 11 or 12 billion dollars he had at the time. He panicked completely. He sold out completely. Paper hands, got emotional. So that's why I'm looking at these guys and I'm thinking I can make a lot better decision than they can. So if someone like Bill Ackman can outperform the index while making these emotional mistakes, buying into something, selling it 3 months later because it went down. I mean, that's so stupid. That's so, again, he's not stupid, but because of the emotions, he got extremely stupid. He wasn't thinking clearly. He was completely overwhelmed with fear and emotion. Okay. That's how we can make a lot of money in the stock market, because of the fear. So guys, when fear takes over the market, it doesn't just take over the retail traders. Okay. People like Bill Ackman, they run tens of billions of dollars and they're like, it went down no more. So, guys, after Bill Ackman sold, it started to go up and it went up by like 500%. That's how bad some of these mistakes can be from these people. I mean, this is not funny. But yeah, even Warren Buffett, like 5 years ago, actually 6 years ago, he bought into airlines. Some of the airline stocks sold off some more, and then he bought exactly at the bottom. Guys, I will never in my life, I promise you, I will never buy into something and then sell it when it's at the bottom. It's ridiculous. If the price goes down some more and I want to exit, I will at least wait for a bounce back, okay? An opportunity to sell. Or I will keep on buying it. Because I only get into extremely good companies, so when the price drops some more, I will buy some more because it makes sense, right? I get it cheaper. I get the same extremely high quality business for even cheaper. But as you can see, I mean, Bill Ackman with Netflix, he's saying, "Oh, I was wrong because the price went down." It's so stupid, guys. I'm a professional poker player. I know a lot of very smart people, but when emotions take over them, they start bluffing, they start calling off, they start playing every single hand. Emotions take over them. They start feeling it into their body. That's how you tilt and you make very bad decisions based off on emotions. Okay, so that's why I don't really trade around. I put all of my money into something that's been dropping a lot, and I don't exit that position until it's played out. Okay, so these people are trading a lot. They're moving a lot of money every single quarter. They're closing down positions. They're buying something new. I mean, he added 20% to Meta. He added 15% to Uber, 10% Microsoft. Some of the purchases, they make a lot of sense to me to buy and own, but not at the current price. Visa and MasterCard, I would love to. I love these companies. I cannot touch them. Okay, very rare opportunities to touch these. And probably I will never get to own them because they are so solid that I don't think the price can go down by 30% or more in these companies. I mean, I've had ADP, automatic data processing, kind of the same super solid company, very high recurring, predictable, extremely high switching costs, That went down by like 40%. I jumped on it. But these are very rare opportunity. S&P Global went down by 30%. I bought it last week. I initiated a position in my margin account. These are the businesses that I like, but some of these super investors, they have complete disregard to price entries. Like, why? Price is what you pay, and the returns matter a lot on your entry point. I mean, yeah, these are anyway. He's not gonna make a massive mistake. He's gonna make money on these buys if he keeps them long enough. These are toll booths, high margin, capital light, very difficult to replace. They sit in the middle of economic activity, and they basically collect a tax as the system operates. So that's part of the portfolio. But again, Netflix, he was like, this is so embarrassing, guys. He's saying, oh, we bought it in 2022 when it was down a lot. We sold it at a massive loss because he tried to make up an excuse, but the reason was he was just afraid. He actually said something like, oh, we didn't want this trade to turn into another Valiant, another major mistake that he made. So he was results oriented. He got fearful and he sold out. Paper pen. And then now, after 5 years, 4 years, he's coming back when the stock went up a lot. Guys, makes no sense. I don't even need to explain this. But he's saying now the business is stronger. No, it's not. What are you talking about? It's the same kind of business. Now there's actually more competitions. Anyway, yeah, he lost a lot of money on it. He got bitter, and now he wants revenge. He wants to make those $500 million back. This is Reddit level emotional trading. Years later, you cannot make this up. But to be fair to Bill Ackman, when you're admitting that you're wrong and you're selling it, it's usually much better than just sitting there praying that your thesis when you're sitting there praying to something for a miracle while your thesis collapses. Okay, that's not good either. Jeremy, financial education, I mean, he had a lot of stocks that went bankrupt, and he kept on saying, yeah, it's gonna come back. It's Tattooed Chef, Voyager Digital. I mean, I don't even remember. There are like 4 different stocks and businesses he invested in that went bankrupt, and he kept it. He rode the 95% down. It's stupid. But yeah, these round trips are pretty hilarious. Let's take a look at the next super investor. Next up, David Tepper, Appaloosa Management. I love this guy. I'm always, every single quarter, paying very close attention to what this guy does. Now, he's not the smartest guy. Actually, I would say he's not the most intelligent guy out there, but he's definitely the smartest guy out there. The smart money, okay? He does make mistakes, but he doesn't make those stupid emotional mistakes that Bill Ackman does. Or the paper hands is like, he's like, yeah, I bought Whirlpool or I don't know, Continental tires. Didn't work out. This trade didn't work out. Whatever. On to the next. He's not like, but most of the time he's just allocating a huge chunk of his portfolio to a certain theme. Might be semiconductors or whatever he thinks that is gonna go up that year. So could be oil, could be healthcare, could be big tech. But in this second quarter, Appaloosa Management added about 24% to TSMC, 55% to Meta. I like that. I recently got involved with Meta. 22% to Uber. Uber is not part of my investable portfolio, but I keep on wanting to research it and find out what the moat is for this company and how strong is it, because they've been doing very well financially over the past 2 or 3 years. Then he added 16% to Amazon. Also 87% to Baidu. Now he's big on Chinese names. He made a lot of money with Alibaba and other stuff. It seems like he trimmed Alibaba, completely sold out of Pinduoduo and JD. Not sure what's going on there. Actually bought Alibaba when it dipped under 100, because I mean last year I made a lot of money buying it under 100. Went up to like 170, 190 when I exited, and now I got the chance to buy it again. It's on a bounce. It's like at 125, I think, right now. So I'm just gonna keep my position and close it again when it reaches 200 or so. But yeah, there's clearly still a big technology and AI infrastructure theme running through the portfolio. TSMC, Meta, Amazon, Google, Nvidia, Broadcom, CoreWeave. These are all sitting somewhere around compute, cloud, AI infrastructure, and the platforms benefiting from it. So everyone screams AI bubble, capex, blah blah blah. But Tepper is the money. Where the money of David Tepper goes, that's what I trust more than what the talking heads on CNBC. Okay. But he did cut out from Micron, Qualcomm, AMD a little bit. But Micron, he knows this name a lot better than anything else, I think. He was he was in and out of it since like 2016, 17. He really knows this name and the oligopoly. But yeah, seeing Qualcomm trimming Qualcomm by more than 50%, I'm not too happy about it. I own Qualcomm, but for me, Qualcomm is more like, it's not an AI play. It's just like a solid infrastructure play when it comes to like 5G, 6G, and mobile. They have some headwinds with Apple cutting them out, but they quickly recovered already. They're gonna just replace that revenue with IoT and automotive. So I mean, I'm very impressed with Qualcomm. But yeah, even after that reduction in Micron, it still represents about 15% of the portfolio. Hold on, let me check that if it's true actually. Yes, it is true. It is 15%, which is enormous. I mean, he's just taking massive profits, which I'm happy about. So he's just taking, like I talked in the other video before, this is what I also want to do with my investments. Buy them when they're low, take profit along the way, and then when the price gets ridiculous and the valuation gets out of control, then I'm gonna completely exit. He completely sold PDD and JD and his remaining China Internet ETF KWeb, and increased Baidu by 87%. I mean, that's a play on AI, I think. So apparently to him, China is simultaneously attractive and disgusting, depending on the ticker. So yeah, he's becoming more selective. I don't think he's saying China good or semiconductor good. And I just think he's moving capital around inside of those names. He completely sold off American Airlines in Q1, and then he bought American Airlines again. So you cannot copy David Tepper. He is someone who moves fast. But when David Tepper buys something in Q or sells something in Q1 and then comes back at it in Q2, it's not because he thought he was wrong. He was just placing capital somewhere else. That's why his fees, his commissions are very high. He's the highest paid hedge fund manager on Wall Street because he's very, very good. I mean, he's been averaging like more than 30% per year. I mean, this guy is a beast. This guy is a monster. And he's not afraid. I mean, he's just gonna buy anything that he thinks is very undervalued. He's not married to one sector. He's not married to one company. He moves. And I love to see that. I mean, one day I hope that I can move as fast as him, to compound as smoothly and as fast as him. But yeah, it's just about allocating capital where we think the opportunity is best now. So obviously, Q1, the airlines, he thought, yeah, better sell out and put this money to work somewhere else. After he sold out of Micron, he said, okay, I took profits. Now let's put this the profits that I took from here back into the airlines. So next we're gonna take a look at is Lilu, because he took the opposite direction and it made Pinduoduo a massive position. I mean, this guy knows Chinese stock. I mean, he's Chinese, okay? It's like the Chinese Warren Buffett, they call him. So we're gonna take a look at Lilu next. Now we have Lilu here, and honestly, I'm much more interested in how this guy thinks rather than whether he bought 6 million more shares of Pinduoduo this quarter. He made a huge move. Yeah, he more than doubled his Pinduoduo position and it became 22% of his portfolio, which is huge. He sold off of some names, but the reason I follow Lilu is his investment philosophy. My last video, we talked about how I'm extremely concentrated, owning just 3 names in my non-margin accounts, which is most of my portfolio, most of my net worth invested in. And Lilu overlaps almost perfectly with the way I think about investing. He starts from something incredibly simple. When you buy a stock, you're buying a part of a business, okay? You're not buying a ticker, you're not buying a chart. You're not trying to guess what some talking head on CNBC is gonna say tomorrow morning, okay? You own the business. And because the future is uncertain, you demand a margin of safety. Lilu describes the market as something that should serve you, not guide you. Most of the time, you can just ignore the market, but occasionally the market becomes extremely optimistic or extremely pessimistic. Exactly what I think that can happen, and exactly what I'm looking to exploit: extreme highs and lows. And that's when the price can become useful. So this is basically how I invest. I don't need the market to agree with me. I just need the market to occasionally give me a ridiculous price. Adobe down more than 2/3. Okay, Fiserv down 75%. ServiceNow down 60%. So the other huge overlap is the circle of competence. This is something, of course, taken from Warren Buffett. Lilu says that you can build this circle of competence through long-term study. You need to understand why the company makes money, how it makes money, what competition looks like, what gives the business its advantage, and whether that advantage can actually survive. This is why I spend so much time. I spend so much time companies that I don't even own. I spend time studying them. The work happens before the opportunity. That's why I can have so much conviction to just deploy a large amount of capital. When something falls 50 or 60%, I'm not worried at all. When I see something dropping like a rock, a falling knife, I jump into it. I try to catch falling knives. Karl Marx says that's our job. Our job is to run inside buildings that caught on fire. Our job is to catch falling knives. Okay, we're gonna talk about Karl Marx next. But yeah, so what does the company actually do when you see something that dropped 50, 60%? It's already too late for that. Don't invest in that because you don't understand it. You might put money initially and then you're gonna paper hand like Bill Ackman. It's like, oh no, we misunderstood. We lost 500 million. Bill, it. We were wrong. I mean, why didn't you study Netflix before you put like 11% of your portfolio into it? I mean, you know what I'm saying? But yeah, Himalaya Capital Management, he said, if an analyst really understands the company, they should be able to think through the worst case economics of that business 10 years into the future, not just the beautiful bull case. What could go horribly wrong? Okay, what does the company look like after that? If you cannot answer that, maybe you don't understand the business nearly as well as you think you do. And I love that how he said that, because that's exactly where concentration should come from. Not confidence, not excitement, not knowledge. It should come from knowledge, okay? And that's the philosophy that overlaps with mine the most. He's always ran extremely high concentration portfolios, and seeing someone like that who does a lot of work, studies, does extensive study into the stocks that he buys into, it gives me a lot of confidence that, hey, this can be done. You can put a lot of work into something, understand it very well, wait, and then when the opportunity arises, an exceptional company, huge moat, and the price that makes no sense, that's when you swing hard, okay? So Lilu also specifically warns about the opposite mistake, finding the fat pitch and then being unwilling to put enough capital behind it. And this is almost exactly my philosophy, okay? I don't want 50 positions in my portfolio because I feel obligated to own 50 things just because I need the feeling of safety, or that's just the crowd mentality of diversification through owning a lot of different names, okay? I want to spend years building knowledge, wait for opportunities, and then when it actually lines up in the way that I'm satisfied deploying a lot of money into, that's when I strike. Long-term owners of high-quality companies, that's what Himalaya describes itself today. Substantial economic moats, strong growth potential, trustworthy management. Some investments are held for decades, okay? That's why Lilu is someone I pay attention to whenever he speaks and whenever his 13F starts to come out. By the way, they are only obligated to report the tickers they own on the US stock exchange. So This portfolio right here that you see on Dataroma or whatever site you use for checking out 13Fs is not the entire portfolio. They have some other names as well, but they do own, they are very concentrated in their portfolios. So yeah, let's go on to the next. Now we have Terry Smith, and Terry Smith is interesting to me always because I agree with a lot of his philosophy. Not all of it, but his whole entire framework, his strategy is basically buy good companies, don't overpay, and do nothing, which I think is not a very bad strategy, but it's mediocre at best. And I think you for sure, you underperform the index by using this strategy, because if you do nothing, and at some point your companies that might have been good companies, which is already bad to start with, I only invest in extremely high quality companies. And when he says buy good companies, he actually means just good companies. I mean, he would Kellogg's. I don't know if he actually invested in Kellogg's, but he has these type of companies where, like McCormick, selling spices, stuff that people they need every day, reusable stuff. McCormick is never going to be an excellent and extremely high quality company. Okay, there's always going to be high competition. It's not really recession proof. I mean, I don't know how to explain it, but when he says buy good companies, it's just good companies. Most of the companies in the S&P 500 index are good, if not excellent. Okay, most of them are very good companies. So my standard of buying companies much higher than Terry Smith. So also when he says don't overpay, I just don't agree. I mean, stocks never go up in a straight line. Sometimes they go down a lot, and no name is immune from this. Even the best companies in the world, they can go down. I mean, Terry Smith felt the pressure. He had Meta, Facebook at the time. It went down by 75%. He didn't sell. Meta was a very good company, but even that can go down by 75%. So I'm looking to get those kind of opportunities, not just don't overpay. I'm not just allocating capital and buying a good company just if it's at a decent price. You're not going to outperform the market by doing that. So yeah, that's the strategy. Unfortunately, this is just not going to work for him. And actually, he's changed last 2 quarters. He actually changed his strategy, and he started to do different things. And now I think it's just a mess in his portfolio and what he does basically. So Terry Smith wants companies with very high returns on capital, growth, predictable economics, which is what I want also, and management that allocates capital intelligently. He said that he likes businesses that make money from a huge number of repetitive, everyday transactions rather than businesses that depend on one giant project or one unpredictable hit. Completely agree. I would never buy some biotech lottery ticket, some biotech stocks. I don't want that kind of stuff. So that makes complete sense to me. I want the same thing: recurring revenue, high returns on capital, predictability, strong cash generations, businesses where the economics are easy to understand and hard to destroy. Where I start to disagree with Terry Smith is obviously the do nothing part, because I don't believe I don't believe that a great company, so not just a good company, okay, definitely not a good company, but not even a great company automatically deserves my money forever. Just buy and hold forever. Price matters just too much. Opportunity cost matters too much. So let me give you an example, okay? Let's say you made a lot of money with something, Nvidia. You bought it in 2023, made a lot of money with it, and you never took profits along the way. And you never redeployed that capital. Nvidia is now $5 trillion. How are you going to continue to compound that money? Especially if it gets extremely expensive at one point. Another exceptional business can get destroyed while your own can get ridiculously expensive. I'm perfectly happy to move capital and rotate the money and compound it that way. I don't want to own companies forever just because they're good or great or exceptional. Just because a company is exceptional doesn't automatically tell me in my head, oh yeah, that's the strategy. just buy and hold it forever. That's how we're gonna underperform. No, that makes no sense. Show me some type of calculation. I'm gonna show you how the S&P 500 moves. I'm gonna show you some calculations about that, and you have to show me some type of calculations of how you're gonna overperform the index, the market. So yeah, buy and hold good company is just not a good idea. Anyway, his portfolio right now is a complete mess, in my opinion. I mean, he reduced a lot of names. He bought into Uber, MasterCard for 4%, but he also had Visa. So he reduced Visa with 35%, bought MasterCard. Total of these position is 10%. Okay, nothing to say there, but he bought TSMC. Very strong buy, but kind of late to the party, to be honest. He bought Netflix. He bought AppLovin, which we found or in an earlier video. We're gonna take a look at, and this is very interesting to see that he bought into this, because now I want to really take a look at it. And if he saw something of economic value, like some kind of moat, and if he thinks AppLovin is a very good company for him to buy and hold, then for sure there are some moat aspects that I haven't seen. Or maybe he's just gone crazy and he's just buying these hyped up names. Viva Systems he bought in, which I highly agree with. Viva has a very deep vertical moat in the healthcare industry. What else? FICO for a very low amount. Interdigital. I used to own this. It went up a lot. I exited. O'Reilly's. I really like O'Reilly's. I think it's now on a small dip, which is nice. And then he sold out of Paycom. Interesting. I'm not sure at what price he sold off, but the Paycom did move up a lot, but it was a very small position anyway. And he sold out of Vertiv. Anyway, it doesn't matter. Yeah, that was pretty much it about Terry Smith. I mean, I'm not sure what he sees in AppLovin. Maybe it's a much higher quality business, so I'm gonna make a dedicated video about that. But that's how I think the 13F should be used, not like a shopping list, okay? Just a source of ideas, and not just a source of ideas, but observe very deeply and try to understand what the guy is doing, what the guy is thinking. What is his strategy to outperform the market? Is it going to work? Is it better than yours? Do you see some flaws in it? Okay. When I see buy good companies, don't overpay, do nothing, already I can prove it to you that you're not going to outperform the market like that. But anyway, I love Terry Smith. I learned a lot about Terry Smith. Actually, the term investable universe, I got it from him. Warren Buffett calls it the circle of competence. But yeah, I like investable universe much better because it represents like a list of companies. It represents your hunting ground for deploying capital. Yeah, let's move on to the next one. Now we have Chuck Akre. And again, I'm much more interested in how Chuck Akre thinks than whether he bought another 200,000 shares of something this quarter, okay? I always try to find out how the guy thinks, what is his strategy, how does the outperformance happen? So just copying someone is just stupid, obviously. You have to get inside their head and develop your own high-quality thoughts when it comes to investment. So Akre Capital has one of the simple investment frameworks I've ever seen. They call it the three-legged stool. So that the business, the management, and the reinvestment find extraordinary business and make sure competent people are running it, and then make sure that business has someone intelligent to reinvest the cash it produces. So this is very important because just buying and holding it for a very long time, but without the possibility of that business to reinvest the cash and compound, you're just not going to outperform. So yes, he does buy and hold for a very long time, but he makes sure that the business that he buys can compound for a very long time. So when all three legs of the stool are exceptional, Akre calls it a compounding machine. So they explicitly say that they want to concentrate capital into a limited amount of these extraordinary businesses. So again, we come back to concentration. Last video I made is why I own only 3 stocks, okay? And why I'm extremely concentrated. In a lot of these guys' portfolio, even Bill Ackman, Chuck Akre, Lilu, a lot of these guys are just very massively, highly concentrated. into just a couple of businesses, exceptional businesses, and I love that. That's a huge overlap with how I think. So he asks, what happens to the cash? Because generating free cash flow is only half of the game. Can the management reinvest at high level of return? Can they buy back stock intelligently? Can they make acquisitions without setting shareholder money on fire? Can this machine get bigger and bigger and bigger without constantly need more and more capital just to stand still? The capital allocation price matters enormously to me, okay? He has written about bottleneck businesses with this is a concept that is very familiar with some of the stuff that I like to call choke points and toll booths. So basically businesses where businesses that occupy crucial positions in an economic system where customers cannot avoid them. They have to pass through them. So I like to call them toll booths or choke points. So think about right now, AI semiconductors are very hot. Think about ASML. You cannot produce advanced semiconductors without ASML machines. Or in the same semiconductor industry, you cannot even begin to design the semiconductor, the chip, without using Synopsys, EDA, and Cadence design systems, or even Siemens EDA. But yeah, that brings us to Chuck Akre's recent moves. They added another 13% to ServiceNow this quarter, which I like. As you know, ServiceNow is my biggest position. I put like 40% of my net worth into it. So I'm obviously interested in ServiceNow because I own it, and it makes complete sense through Chuck Akre's framework to buy that business, hold it, add some more. Strong business model, recurring revenue, extremely embedded customers, high switching costs, huge amounts of free cash flow, and the ability to keep reinvesting into additional workflows, products, industries, and acquisition. This is what a compounding machine is supposed to look like, exactly like ServiceNow. And this is where me and Chuck Akre, we overlap heavily. But there is one difference. I care much more when I buy it. I like to buy it when it's down a lot. He just says he wants an extraordinary business with reasonable valuation. I'm a lot greedier, okay? I want very high rate of return, and I want extreme high outperformance when it comes to the S&P index. I want to beat the shit out of the index, okay? I want pessimism before I buy the stock. I want the ugly chart, I want the falling knife. I want expectations to get crushed. So I don't just collect stocks. I try to find, just like him, exceptional economic machines, understand why they compound, understand what management does with the cash, and then put meaningful capital behind the businesses that actually deserve that capital. And seems like Chuck Akre has been shopping in my own investable universe, because he also bought CoStar, which is another company that is in my investable universe. So let's move on to the next. Next, we have Howard Marks. This is one of my favorite investors of all time. And this guy, I'm going to be honest with you, he's not here because I'm looking at necessarily at his 13F moves. Oaktree is managing over $100 billion. And I mean, their stock portfolio is like $4 billion. He is mostly investing in distressed debt, credit, equities, and he has other strategies. So yeah, high yield bonds and stuff like that. So we're not really gonna look. Sometimes he has some very interesting ideas. Actually got some interesting idea from him last year when I was looking for semiconductors. He had a very small name in there, but anyway, that's not why Howard Marks is in this video. He has probably influenced the way I think about markets more than almost anyone. Okay, his most important ideas are incredibly simple. If you want different results, you have to do something different. Dare to be great. That's what he says. So benchmark hugging is comfortable. Following the crowd is comfortable. Owning whatever agrees is safe is comfortable. But comfort and exceptional performance are just not the same thing. So you cannot take the same actions as everyone else and expect to outperform. So guys, even this has been true in my life. In poker, even before I started investing, you could not make a lot of money if you just played exactly like everyone else. You had to be different. You had to be a contrarian. Okay. When everyone was aggressive, you had to be a little bit tighter, a little bit trappier, set traps. And whenever everyone else was tighter, then you would push some more aggression on them. But yeah, when it comes to investments, I found this guy and I thought, this is perfect for me. I can take advice from this guy. And I want to incorporate a lot of the stuff that he says into my investment philosophy. You cannot take the same actions as everyone else and expect to outperform. It's just not going to happen. So that overlaps massively with how I think. If everyone loves the company, if every analyst has a buy rating and the price is at an all-time high, the story is perfect, and everyone expects greatness, guess what? You have no edge. You're just going to lose money. You're going to buy in at the top. It's going to go down from there. And even if it goes up, it's not going to go up by a lot because everyone is already in. So I want the opposite situation. I want the company everybody is scared to touch. Adobe. Think about Adobe. I want the ugly chart. I want the horrible deadline. I want the earnings call where everyone sounds like someone died, which is not true actually. With Adobe, every earnings call that they put out is great. I mean, every news about them is great. It's just the stock price is completely crashed. But yeah, you can have something like that, even better, when expectations are good, exceptional, but the stock price is completely detached from reality. But yeah, the hard marks calls this the second level thinking. First level thinking says this company has a problem, sell it. Second level thinking says ask everyone knows it has problem. How bad does the market think those problems are? What is already priced in? What do I think happens? And how different is my view from everyone else's? The gap between consensus expectations and reality is where opportunity can exist. So this is basically the center of my entire investment strategy. Adobe falls 60%. Okay, I don't ask why is Adobe falling. Everyone knows why Adobe is falling. I want to know, has the market fallen further than the economics of the business? Is it justified? That is completely different question. So when Howard Marks get into something and then he gets into something I love, falling knives. Okay, so during market panic, everyone loves saying, we don't want to catch a falling knife. Don't catch a falling knife. We're gonna wait for the dust to settle. We're gonna wait for more certainty. And Howard Marks specifically says that our job is to try to catch falling knives. He warns against those phrases that dictate your behavior, and deciding not to act is still a decision. So if you wait until everything is saved, the price is probably not distressed anymore. So you will never catch bottoms. So this is where I take his philosophy and turn the aggression up a level. So I think, like he said, our job is to see a burning building and be willing to run inside it, okay? But not blindly, not because something fell 70% and therefore it must be cheap. Some burning buildings are burning because they're about to collapse. You don't want to enter something that is about to collapse. Some falling knives are just garbage companies, okay? You don't want to catch some stupid Cathy Wood falling knives that's about to go bankrupt, okay? You don't want to invest in Cathy Wood, ARK Invest garbage, okay? So I try to look for panic. I try to look for fear. I try to look for uncertainty. And then when lower price creates a higher potential returns for me, that's where the underlying value is for me. So Howard Marks made this point during the 2020 crash. Oaktree explicitly rejected the idea that it had to wait for the bottom. His view was that you just buy when value becomes sufficiently cheap. Maybe you add some more later, but you buy it knowingly perfectly well that prices may continue falling. So I bought Adobe. I'm still down on my position. I have no problem with it. If I find some more capital available to me, I will buy some more. But I have no problem being 15% down on my position. It's nothing. I'm very glad that I caught the falling knife in Adobe. I don't know when it's going to go up. I don't try to time the market. I bought it when it made a lot of sense to me, when I saw the fat pitch. So if I buy something like Adobe when it's down 60% and it falls another 20%, but 5 years later, I'm up 500%, I did very, very well. So, and there's also a lot of another massive overlap between hard marks and me. The risk is not just volatility. So volatility for me is not risk. Oaktree's entire philosophy begins with the primacy of risk control, and hard marks has spent decades distinguishing price fluctuations between the possibility of permanent loss. Oaktree is obsessed with protecting capital, understanding downside, and surviving environments where the other investors are forced out. So that matters enormously when you're contrarian, because being contrarian is easy to talk about, but when it comes to actually buying something, while everyone else thinks that you're an idiot, and then having to watch that stock price fall another 20%. So I bought Adobe. A lot of people think that I'm an idiot for buying it, and then the stock price drops some more, and you start wondering. I mean, you start doubting yourself. Maybe they're right. Maybe I'm actually an idiot. So you might look wrong at first. You might look wrong for a very long time, but that's just, I mean, you just have to accept that you're going to go through stuff like that. So that sentence, you may look wrong for a long time first. I can put it on my wall. Okay, that's investing. You buy something that nobody wants. Nobody wants Adobe. Okay, it's software. AI is gonna come and vibe code everything away. Okay, it keeps falling. Everyone tells me that I'm an idiot. No, nothing happens for a year, for months. I first bought Adobe last year around this time. But eventually, the economics win. Eventually, I will be right. The sheep are gonna get slaughtered. The sheep are always wrong, my friend. That's the game. And that's why I love Howard Marks. He doesn't pretend investing is about predicting next quarter, okay? It's about understanding value, understanding also psychology, cycles, market cycles. He talks a lot about market cycles, thinking differently from consensus, having the emotional discipline to act when everyone else is scared, having enough respect for risk that you survive when your contrarian bet turns out to be wrong. So my version is probably slightly even more aggressive. Hard Marks says dare to be different. I say, when I've done the work, business survives, the price becomes absurd, and everyone else is running away. You know what I'm gonna do? I'm gonna grab the fire extinguisher and I'm gonna run inside the burning building, and it's gonna be mine. It's gonna be mine to own. When we're gonna repair it and make it all beautiful again, I'm gonna have those 400, 500% gains. And you say, nah, that's not possible. 500%. How are you gonna just make 500% on a trade in like 3 or 4 years? If you bought Meta when it went under $100, you could have sold it today at a more than 500% gain. It's not that crazy, guys. It's not that hard to make 100%, 200%, 300%. Okay, you don't have to make 500%, but doubling up your money on a very high quality business, very easy. Google, extremely large cap company. I bought it last year at 150. Now it's like, I think it also touched around 400 at some point. It's not that hard to make those kind of gains. Even not 100%, you can make 80% consistently on your trades. Trust me, it will take years and years and years to make 80% on the S&P 500 index. So that's the whole point of going outside of the index and try to invest in individual stocks. Make those 80% here and there, 120%, 200%, 500% every now and then on something like Micron and Facebook Meta and stuff like that. That's just part of it. So yeah, I'm gonna end the video now and see you guys in the next one.